Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and in the weeks ahead. Today I'm joined by Brian Dangerfield and Paul Robson, who are two co-heads of G10 FX Strategy. It has been another week where Iran headline risk has really driven markets, as well as the gyrations in oil prices. Brian, I'm going to come to you first because, with oil prices staying as elevated as they are, how are you seeing the Fed really internalizing these risks at their next meeting?
Well, sure. Let me just start. Maybe it's worth taking a quick discussion of oil prices. And I do want to give Paul an opportunity to weigh in on how he's sort of seeing things. But maybe just to start off, clearly this week, oil prices have been extremely volatile. We had a very massive jump in oil prices at the Asia Open on Monday. We've since retreated very far off those levels, but it does feel like each day, really, of the last week and a half or so, that the market has come into it with a very distinct, different kind of posture as regards to the short versus medium versus long-term implications. And what I mean for that is that it certainly feels like at some point risk markets feel maybe a little bit more comfortable with the possibility that the conflict will end sooner and that supplies will normalize sooner. And then in other sessions, you sort of get the sense that the markets are maybe trying to retrench a little bit for a longer term disruption to growth. And what I think is the frustrating reality here is that so much of this is tied to the US president and his opinion about the state of the conflict, the goals for the conflict, and what the realistic next steps should be. And, one of the really difficult things, I think, for markets is that the president's goals in this conflict have been somewhat fluid, let's say. That in some senses you get the idea that the president wants to push for regime change and for a more wholesale change in conditions in Iran. And that's something that I think the market believes will take a lot longer to actually execute if that's the ultimate goal. But of course, there's another possibility, which is that the president talks about whether the active military campaign is targeted at reducing Iran's ballistic missile capacity, reducing their, the size of their military, their capacity to strike U.S. and other assets within the region. And that's something that could achievably be, reached sooner, a point where the U.S. and Israel feel that there's the ability to step back. And I think the market kind of is trying to find which of those is the more likely path. At points, it feels like, it's self-defeating to consider oil prices as we're trying to measure those two very different possibilities. And a lot of it feels like it comes down to the president, which I think is one reason why the markets are simply so focused on domestic pressures on the president that come from energy prices and from oil prices. Some of the big things we saw this week was the U.S. and global actors, what I would consider treating the symptoms rather than treating the underlying cause of higher oil prices, which is taking action to release emergency stockpiles, 400 million barrels per day among IEA members, for example. Other options that the U.S. is considering include defending ships in the region from potential Iranian attacks, plans to reduce the cost for insurers to try and reduce the risk of allowing ships to move through the Strait of Hormuz. There's plenty of other options, including things like intervention directly in oil futures markets that are reportedly on the table. But at the end of the day, it feels like there are limits to how much these can reduce the risks to oil prices if the active conflicts continue. And so I think that's really the challenge here with the near-term outlook, is that I think there's as good a case for the conflict to scale back rapidly as there is for it to continue to sort of drag on. It really comes down to, frustratingly, where you think the president feels the pressure and if you think that the president is closer to his ultimate goals here or he's further away. And so happy to talk a little bit more about how, I'm thinking about that in FX markets, but I do want to give Paul maybe an opportunity to jump in. How are you thinking about Iran here? And so maybe some broad thoughts on the state of the war and how FX markets are sort of internalizing that.
Yeah, thanks very much, Brian. I think from my side, it comes down to central bank reaction functions to a large extent. And as we know, not all central banks are born equal in the way they can accommodate or not accommodate a transitory sort of inflation shock this time. Energy, we've had in the recent past, haven't we, supply constraints on goods and COVID, and that has the potential to impact currencies. The other one is through fiscal policy. And again, governments aren't all in the same position. Some have clearly greater scope to try and offset some of the impact. And I'm sort of thinking that there's not a lot in life you can depend on. And there is that saying, isn't there, that two things in life, death and taxes. But at the moment, there seems to be a third. One is greater government spending, and that pressures yield curves or yields higher, and currencies can be really quite sensitive to slopes of yield curves, most notably, I think, for the dollar, but certainly for the UK in recent years. I think you summed it up excellently about it's a lack of a sort of objective set out by the US administration. I've tried to think about it in a way that you would set objectives in your sort of day-to-day jobs. So when you set objectives, you can think of it in a sort of SMART framework. Objectives should be specific, they should be measurable, you should be able to attribute them to people, they should be relevant and time-bound. And if I think of it in that context, it's clear that the objective wasn't really specific. You quite rightly mentioned about, what is the goal here? Is it regime change? Is it military degradement? That kind of things. We don't really know for sure, do we? We think it's sort of attributable and sort of relevant, but measurable. We're not quite sure how to even measure what success might look like and what the off-ramp might be, and certainly what the time frame is. And when I look at the calendar, there are some dates that sort of jump out a little bit. Donald Trump's state visit to China at the end of March, that seems to tie in quite well. But I think for now, you're exactly right. We follow energy prices, oil prices, natural gas prices here in Europe, and how central banks react and how governments react, and the extent to which governments have the ability and the willingness to do that.
Yeah, Paul, maybe I'll jump back in here and just sort of mention it from the dollar side. I think you brought up a good point in general, which is that, across economies, this same crisis creates very different reactions and responses. And one of the things that feels like it's maybe not universal, but pretty universal across major economies is that one of the consequences here could be more fiscal spending, and how some currencies and regions are clearly more sensitive to those specific risks than others. You think about sterling and yen, maybe on the more sensitive side, at least in recent history. The US in other cases, maybe not so much. And I mean, as I think about the dollar here and the rally that we've seen in the response to higher oil prices, I feel like there's two pieces of this move that should be treated maybe not separately, but as two distinct entities of a dollar move. The first one being these differences of response, whether it be central bank reaction functions, as you rightly mentioned, Paul, whether it be relative growth, exposure to specific lost barrels from the Strait of Hormuz. And I think it's absolutely right to say that when it comes to lost barrels and oil as a specific risk, due to geopolitical tensions, that the U.S. is a relative winner in the FX space, simply because our exposure here in the U.S. to imported oil from the Middle East is just so much lower than most other places. Not only are we a large oil producer ourselves, almost all of the oil and energy that we import from abroad here in the U.S. comes from the Western Hemisphere. Canada is by far the largest of those. So I think that's understandable as the first order reaction to be sort of the, you dust off the Russia-Ukraine playbook and it's dollar stronger. But there's a second piece of this, which is positioning, right? Which is that I think the market, ourselves certainly included, went into this escalation with a broadly weaker dollar stance. Certainly, and I'll ask you, Eimear, in just a second to talk a bit about emerging markets. But I mean, it has been a very, very strong start to the year for emerging markets, and that had fueled a very good start to the year for carry-seeking currencies and a weaker dollar. And so, I think a second related piece of this move is positioning. And on the positioning side, it's maybe a little bit clearer that the market flipped, I think, very quickly from a short dollar position to at least a neutral dollar position, if not an outright long dollar position. And so as I try and think about those two drivers separately, one of them feels like it's very sensitive specifically to the ultimate destination for the conflict, which sort of goes back to some of those frustrations we were just sort of talking about. But then the other one on the positioning side, it's maybe more easy to say that maybe the worst of a positioning reset related move is over. So as I think about the dollar here, that's how I'm trying to frame this through as I look through the lens of global currencies, is that positioning has reset. And now I think the next move in the dollar probably links more to that specific, how much does this growth hit extend? How long does the conflict extend? And, there's certainly a possibility that we move into a much more positive direction, but, we have to be humble to the alternative scenario. So, Eimear, maybe I'll throw it back to you before I talk a little bit about the Fed and the specifics. And certainly want to ask you to get policies on sterling as specific here as well. But what's going on in emerging markets right now? How are you thinking about things? I feel like it was a very good start to the year for emerging markets. It's been a very difficult time here. How are you trying to differentiate and think about emerging markets?
Yeah, I think you're absolutely right that we saw, a big unwind of some of those favored long positions. And if I look at the emerging market currencies that really sold off in the wake of the Iran conflict, a number of them actually stand out. For example, South Africa, which is actually quite insulated from this conflict. It is relatively, energy independence. It's got a national energy regulator, which can actually set electricity prices. So it really helps to spread the impact of any kind of sharp increase in energy prices, which could impact inflation. And I think the fact that it's been one of, the biggest underperformers against the dollar in the days following the conflict really just speaks that investors are taking off risk. I do think that, we're transitioning from that first initial market reaction, which is that unwind of positioning, to the second leg, which is actually who is the most exposed. And I think you are seeing, that divergence between, the countries that have energy and the countries that don't. So for example, Malaysian ringgit, Colombian peso, they have been much more supported, much more resilient against a stronger dollar, whereas currencies such as the Hungarian forint, the Polish zloty, have been much more at risk. And I think particularly as a region, CE3 are very compromised in terms of higher global energy prices and also reduced supply and security of supply, given that they have, limited supply coming from their traditional supplier, which obviously was Russia.
Yeah, I think that broad point is definitely true in emerging markets and in G10, is that there have been pretty distinct winners and losers, from the market's initial reaction. And I think a good chunk of that does come down to these relative exposures in the market sense of where are the vulnerabilities to higher energy prices? Where does this derail central bank expectations? Where does fiscal policy start to really hurt? Paul, I do want to bring you back in here to talk a little bit about sterling, because I feel like sterling has been maybe a better performer, certainly within the G10 space. I would say it's almost resilient, holding up well, maybe is a good way to put it. How are you thinking about sterling here, and what do you think the risks are as we think about the conflict?
Yeah, as you say, I think one of the big surprises is in the currency reaction to the conflict in the Middle East is the resilience of sterling. Obviously, if you looked at sterling against the dollar, you might not get that impression, but that's by far a dollar move. The dollar is the strongest currency globally since the crisis started. But if you look at some of the crosses, for example, euro sterling, it continues to move lower. And as we've sort of talked about in the past, sterling can be a bit of a fair weather currency. It tends to need international investors to be in sort of quite positive mood, equity markets going up, macro volatility lower, if it's to do relatively well on the crosses. And obviously we haven't had that. I think the drivers of sterling's relative performance are very much like you've mentioned more broadly about positioning and repricing of central banks. So I think markets would have gone into the conflict probably short sterling on an expectation that the Bank of England would deliver a series of rate cuts, potentially starting in March, so next week's meeting. But markets have priced that out quite quickly, and then sterling has performed. So I think there is a bit of a relative yield story here, a relative story of positioning. There's other things like reduced near-term political risk. The UK is going to be very unlikely to change leadership in a major international conflict. Maybe also the FTSE is a bit defensive in nature in terms of the structure. And of course, the UK has quite strong links with the Middle East, so maybe there's some kind of capital flow, but it's overwhelmingly, I think, the Bank of England reaction function. And it ties in with what I said earlier about central banks aren't born equal, and the bank of all the major central banks, I think it is the Bank of England that can't accommodate this initial inflation shock because of the experience that it's had since COVID and the European energy crisis. So, for example, we went into that energy shock thinking it could be largely transitory. They shouldn't be persistent. Energy price hikes are, over the long term, disinflationary. It should be seen as a sort of tax on consumers and businesses. But you worry about inflation expectations. And so 4 years after that shock, service sector inflation in the UK is at 4.5% against an overall target of 2%. And that just is testament to the degree to which inflation expectations have risen. And I think the upshot is that the Bank of England doesn't cut rates next week and probably doesn't cut rates for the foreseeable future because of that. Now, this situation might be a little bit different from last time. The world economy is weaker. We're not coming out of the sort of sugar high of exiting COVID. Inflation was on the way down. The labour market was weakening. Employment was falling, and just in general, global economy backdrop is weaker. But I think that helps sterling. Longer term, over the next couple of months, I think the area to definitely watch is whether those worries about fiscal policy that have dented sterling sentiment in the past start to return, and gilts have been underperforming cross-market at the same time as sterling has been outperforming. And if that continues, then debt sustainability risks might come to the fore. People might want a greater risk premium for the currency. And so higher long end yields might start once again to weigh on the currency. So we're not expecting the decline in euro sterling, for example, to extend very much further because of these sort of lingering, lurking fiscal risks.
And Brian, just about the Bank of Japan, which will be a key meeting next week, how are you seeing them really react to these new inflationary risks, given their dependence on energy imports?
There's never a good time for an oil shock, but you couldn't have picked a worse time for one for the Bank of Japan and Japanese policymakers, because there are echoes to what Paul was talking about in terms of the UK, where the markets are closely eyeing monetary policy, but also fiscal risks in Japan. We are just coming off of Takaichi's decisive win in lower house elections and market expectations that she will pursue significant fiscal stimulus. Now, that has at times led to major weakness in the yen in concert with weakness in long-term JGBs. But since her win was so dominant, the markets have kind of priced back the possibility that she would take an ultra-aggressive fiscal stance. And instead, I think the markets have kind of taken the new prime minister at her word when she says she wants to pursue pragmatic fiscal stimulus rather than sort of a return to an Abenomics-style full pressure economy where monetary policy is super easy, fiscal policy is super easy. So the markets, I think, are trying to give Takaichi the benefit of the doubt when she tells the market she's going to try and pursue a cut in the consumption tax, albeit without increasing deficit financing. The problem is that this rise in energy prices and imported energy costs pushes back very directly against her main electoral mandate, which was to reduce costs for the Japanese people. That her goal for the high pressure economy, the whole marketing around that, the campaigning around that, the reduction of her consumption taxes on food and beverages is all about reducing the burden for Japanese people coming from prices. And so you layer on top of that higher energy prices, higher imported energy costs. And by the way, not just in Japan, but for all non-dollar currencies, that if you see a stronger dollar against your local currency and stronger oil prices in dollar terms, then that's a double whammy where oil prices, energy prices in your local currency, that impact is widened when your local currency is also weakening against the dollar. And so one of the things that I've been on the lookout for is there any potential slippage in that pragmatic view that Takaichi has recently took on? Is there any slippage in the more fiscally stimulative direction to effectively match the increased tension on the affordability side? And that's certainly something that I feel like is coming all through, that risk is coming all through the G10. But like with the UK, the yen has shown relatively higher, I think, sensitivity to those kinds of risks. So now you bring the Bank of Japan in and say they look very unlikely to hike their interest rates at the meeting coming up next week. But they still seem to be on pace to increase interest rates in April. And I think the question will ultimately be, how do you balance these competing interests where fiscal policymakers are very concerned about affordability, but at the same time, the new prime minister has reportedly leaned against the need for additional tightening. But one of the best potential ways to try and lean against a spike in imported energy is by taking a hawkish stance and maybe lending some support to your local currency. And so I think for the Bank of Japan, it's not going to be about what they do. It'll be about the signaling, because the Bank of Japan has really slow played their tightening cycle, both broadly and in the very narrow cases of pre-signaling. If there's a good case to hike in April, which we still think there is, then the more hawkish evolution of policy would be Ueda coming out, the Bank of Japan governor coming out and aggressively posturing in a more hawkish direction, signaling in that way. But when given that opportunity in the past to say step up in a hawkish way to defend the currency from further weakness, he's generally eschewed that. He sort of he hasn't really taken up the mantle there. And so that's probably the risk as we head into the meeting next week is Ueda has been very much slow playing the need for taking on a more hawkish stance to either defend the currency or to defend inflation from upside risks to coming from imported prices. Now we have a new exogenous shock to handle. Is this going to lead Ueda to maybe take on a more hawkish stance, or are some of the concerns around the pressure coming from fiscal policymakers maybe pushing in the other direction? So super interesting meeting. Still feel like it's a very challenging environment for Japan, as the market might see a doomed if you do, doomed if you don't sort of scenario, because the energy price related issues there are so severe.
Really interesting what you're saying about the new government, because I think if we've learned anything from kind of the post-COVID period, it's how politically contentious inflation is. And I think was it 2024, there was 33 elections and only 4 governments survived unchanged because of that backlash from a cost of living crisis. It's super interesting. Guys, that's probably all we have time for today. Brian and Paul, thank you so much for joining me. If you did like the podcast, please do like and subscribe so you get the latest episode first. Thanks again.